All right, everybody. We've all heard the talk. 87,000 new IRS agents, probably gonna be toting guns. Gunslinging IRS agents. Well, probably not gunslinging, but you get the point. There's new funding, so we need some more IRS agents checking returns, most likely. Before I go any further and talk about why you should check your basis, I'm gonna focus on S Corps, but this would apply to partnerships as well. Again, I want to kind of give high level explanation as to like what increases basis, what decreases basis. We're going to go through that. But before I go any further, if you have any questions, be sure to email. You can DM me at mdeepcpa on Instagram or on Twitter, mdeep_CPA, or just drop a comment on YouTube. And then also, if you're getting value out of my content, 4 simple things I want you to do: like the video, subscribe to the channel, hit the bell so you get alerted when new videos come out, and then lastly, share it with your friends. Don't share the wealth. Don't hog it. All right, we're going to track your basis here. And I want to focus on partnerships, S Corps. And this is going to be a high level discussion. This is just meant to raise awareness. This is not meant to capture every little piece of information, every little like circumstance, every little exception to the rules. You know, it's not meant to do a deep dive of the calculations. This is meant to kind of give you a, oh, okay, this is what I should be thinking about. So here's the deal. You need a schedule. You need that schedule. Why do you need that schedule? Because here's why. If you go to sell your partnership interest or you go to sell your S Corp, you're going to sell it for some price, right? What's your basis in that? Just like a stock. If my cost basis is 100 and I sell it for 200, my profit is $100. I have to know that basis. So you must keep track of it. You also, deductibility of losses. So, like in an S Corp, if you have a loss and you have no basis, you can't deduct it. So you have to know these things, because if you have no basis, certain things happen. And so you don't want to have that. If you have a distribution in an S Corp, for example, that's in excess of your basis, it could be taxed as capital gain. You don't want that. So you're probably like, well, then how do I calculate this? And I'll say this. First of all, I would recommend that you get a CPA to do it, because you need to start from the very beginning of your partnership. And every partner will have his or her own basis. And so what you start with is you're going to start with contributions, here, right? And then you're going to add all your income items, right? All your income items. Add tax exempt income, also increases your basis. Separately stated income items. Now, what is, you're like, Matt, you're just talking all this gibberish already. All separately stated means is, so when you get a K1, which is what you get if you're a partner and you have an S Corp or a partnership, you're going to get a K1. Those numbers go in your personal return. Box 1 is going to be your ordinary business income. It's the income in the business. Box 2 is usually like rental real estate. You might have a box 3 other income. But then you'll see like box 4 will be dividends. Box 5 will be interest income, because these have different tax rules. Like your dividend income, if you have dividend income from a partnership, that will flow to the dividend line on your tax return, because dividends can be taxed at lower rates. So there you go. That's why they do it. Interest income flows into interest income. It does not flow into business income. It's separate. And so that's what they mean. It's just separated out. And then you have, let's say, items that reduce basis. So let's put a big plus here and a big one. So we have deductions. We have separately stated deductions. Non-deductible expenses. So the items, okay, so here's the deal. Items that cut your basis. Deductions, and I'm sorry this is sloppy, but I'm trying to make a point. Deductions, separately stated deductions. So this could be charitable, stuff like that. Non-deductible expenses, and then distribution. So if you pull money out. These are all important things to know. Now, in an S Corp, they do have two components of basis, stock basis, and that's very similar to what you have here, and debt basis. Debt basis in an S Corp is only gotten if you loan them money. The S Corp can't get the loan, you have to loan it money. So a little quick tip there, but here's the thing. Every year, you need to have this because guess what? At the end of the year, you're gonna have a basis. And then guess what? You're gonna do all of this all down here. You're going to start here, go down, you're going to have a new basis. And you keep doing that year after year after year. You have to keep track of this. And at the end of the day, the IRS can audit you and say, hey, what's your basis? And you're like, I don't know. And they're going to be like, well, then you can't take these losses. This is the problem. I think people are taking losses they're not supposed to, and it's because of basis limitations. So my biggest tip for you, keep track of your basis. And if you don't have it, work with a CPA, pay the time, pay for their time, and get it done. So hopefully this is a good video. It covered the basics. Like I said, I wasn't trying to cover every little nuance. I'm just trying to say high level to raise awareness of it. So hopefully you enjoyed that. And if you have any questions, be sure